Hey everyone and welcome. Have you ever clicked buy on a stock and just wondered what really happens in that split second? I mean, it feels so instant, right? But behind that single click is this incredible journey. A story that's gone from people literally shouting at each other in a crowded room to silent, lightning-fast computer code. So today, let's pull back that curtain. We're going to follow that click from your screen all the way through the system to see how it all works.
So here's the game plan for our journey. First, we'll see how we went from total chaos to simple clicks. Then we'll meet the key players, the guardians who handle your money behind the scenes. After that, we'll get into the strategy of placing the perfect order. We'll also tackle what happens when a company itself changes the rules with something called a corporate action. And finally, we'll look at the real costs of trading and where all this incredible technology is heading next.
All right, let's kick things off by jumping in a time machine. Because really, to get just how amazing today's one-click trading is, you have to see the world it came from. And trust me, it was loud, it was physical, and it was often a complete mess.
Can you imagine? This was literally the sound of the stock market. You're not hearing keyboards clicking, you're hearing a room packed with brokers, a trading pit, where they are yelling, screaming, using all these wild hand signals just to buy and sell shares. Lelia, Delia, I took it, I gave it. It was this intense physical fight just to get a single trade done.
You know, the biggest issue with this old system was that it had zero transparency. I mean, check out this real-world problem from back in 1992. You'd see in the newspaper that say Colgate stock is at 100 rupees. So you tell your broker, hey, buy me some. But then they tell you the only price they could get was 155, plus their fee. And the crazy part? You had no way of knowing if that was true. You just had to trust them. So the shift we've seen is just night and day. We've completely left behind that chaotic, slow, and totally opaque open outcry system. What we have now is the electronic market. It's orderly, it's completely transparent, you see the exact same price as everyone else live, and it all happens in literally the blink of an eye.
So now that we're here, in this modern digital world, who are the folks, or, well, the systems, that actually make your trade happen? Because it's not just you and some seller on the other side. There's a whole team of guardians making sure your money and shares get to where they need to go, safely.
Think of it like a flawless relay race. When you place an order, the baton starts with you, the investor. You pass it to your broker, who is a trading member. They run it to the exchange, which is the marketplace. And finally, the last leg is handled by a clearing member, who guarantees the whole thing and settles the trade. It's a super secure chain of command.
So breaking it down, each player has a really specific job. You, the investor, you make the call. Your broker, they're the ones with the license to actually place your trade on the exchange. The exchange is basically the big digital meeting place where buyers and sellers find each other. And that clearing member, they're the ultimate guarantor. They make absolutely sure the seller gets your money and you get their shares. No ifs, ands, or buts.
Okay, time to get into the action. You've done your research, you've picked a stock you're ready to invest in. But, and this is important, how you place that order is a huge strategic decision. This is where you really take control of your trade.
So every single time you trade, you have to make a choice. What's more important to you right now? Is it speed? Is it getting a specific price? Or is it managing your risk? Let's break down the three main ways you can place an order, so you can always pick the right tool for the job.
Here's the simple breakdown. A market order is all about speed. You're basically telling your broker, I don't care about the exact price, just get me in right now. A limit order is the opposite. It's all about control. You're saying, I'm only willing to buy at this price or lower, period. And a stop-loss order, well, that's your safety net. It's designed to automatically protect you if things go south. The secret sauce of a stop-loss is something called the trigger price. It's awesome. Think of it like setting an alarm on your phone. You tell the system, hey, if this stock ever drops down to this specific price, that's my trigger. Wake up and automatically sell my shares. It's an amazing way to take emotion completely out of your risk management plan.
Okay, so you've bought your shares, the trade is done. You're an owner. But wait, the story doesn't always end there. Sometimes the company itself decides to make a move that directly impacts your shares. These are called corporate actions.
So what is a corporate action? Really, it's just any big move a public company makes that affects its shareholders. It could be something like a stock split or issuing new bonus shares or paying out a dividend. It's basically the company deciding to change the rules of the game for everyone who owns a piece of it.
Now you have to remember this. This is the golden rule of corporate actions. They are designed so that the total value of your investment stays exactly the same at the very moment they happen.
The point isn't to magically make you richer or poorer overnight, it's just to restructure things.
Let's make this super clear with an example, okay? Imagine you own 100 shares of a company and each share is worth 500 rupees. Simple math, right? Your total investment is worth 50,000 rupees. Now, the company announces a 1-for-1 bonus issue. That means for every share you own, they give you another one for free. All of a sudden, you have 200 shares. That's amazing. But look what happens to the price. The market automatically adjusts it down to 250 rupees per share. The end result, your total investment is, you guessed it, still exactly 50,000 rupees. The pie is the same size, it's just been cut into twice as many slices.
All right, we're on the last leg of our journey. Let's talk about the costs you don't always see, and then we'll get a peek into the absolutely mind-blowing, high-tech future of trading. A future that, in many ways, is already here.
You know, every single trade has some costs baked in. There are the obvious ones like user charges, fees you pay your broker and the exchange. Then there are statutory charges, which are basically government taxes. But there's a sneaky one called impact cost. Imagine you try to buy a huge number of shares in a stock that isn't traded much. Your own big order can actually push the price up while you're buying. That little bit extra you end up paying is the impact cost.
And this brings us right to the future. Now, you hear these two terms thrown around a lot, quant trading and algo trading. Here's the easiest way to think about it. Quantitative trading is the brain. It uses super complex math and tons of data to figure out what to buy and when. Algorithmic trading is the hands. It's the computer code that takes those instructions and executes the trades perfectly and automatically.
And the advantages of algo trading are just massive. First, it's completely emotion-free. The computer doesn't get greedy or scared, it just follows the code. Second, the speed is, it's insane. We're talking microseconds. And that incredible speed is what makes high-frequency trading possible, where thousands of trades can happen in the time it took you to blink.
And all of this leads us to one final, really powerful question to think about. As the markets get faster, smarter, and more automated, what is the role of the human investor? Do we still have an edge? Is there still value in long-term vision, in deep-down understanding of a business, or maybe even in good old human intuition? That's the big question we'll all be watching unfold. Thanks so much for joining me on this journey.